Welcome back to The Explainer. Today, we're unpacking a massive player in the global audio market, Tencent Music Entertainment Group, or TME. If you follow the digital entertainment space in China at all, you already know TME is an absolute heavyweight. But today, we're putting on our skeptical investor hats. We're digging into a comprehensive investment memo to figure out if this company is actually as bulletproof as its massive scale makes it seem. We're going to break down their financials, their big strategic pivots, and honestly, some recent moves that might just make you rethink the entire narrative around this stock. Let's dive in. So here is the absolute crucial question we are investigating today. Is TME a resilient compounder, a high-quality business that just steadily grows your capital year after year? Or is it a statistical value trap, where a super cheap stock price is just masking a fundamentally eroding business? Now, on the surface, the numbers look incredibly shiny. They generate tons of cash, they have massive reach, and the valuation looks like a steal. But in the world of investing, a shiny surface can sometimes hide some pretty deep structural cracks. Our goal today is to look right past those headline numbers and figure out exactly what kind of business you're really buying if you decide to put your money here. To understand where TME is today, we need to do a super quick rewind. TME wasn't born as some standalone, founder-led compounding machine. Its origins actually trace back to the China Music Corporation era in 2012. But the real inflection point happened in 2016, when Tencent took control and orchestrated this massive roll-up of music assets. TME goes public on the New York Stock Exchange in 2018, but I want you to notice that 2021 milestone right there. That was a major regulatory shift, where China essentially forced the end of exclusive music licensing. Boom. Suddenly, the structural moat TME enjoyed, locking down all those exclusive rights, was just dismantled overnight. Meaning, their competitive advantages are largely inherited from the broader Tencent ecosystem, not necessarily built from a purely organic, untouchable product. All right, Section 1, Surviving the Pivot, Music versus Social. Now, to their credit, management didn't just roll over when regulators changed the rules. Take a look at this dramatic directional shift in their revenue mix from 2023 to 2025. While overall total revenue is up, those recurring online music subscriptions have rapidly surged to take the lead. Meanwhile, the highly scrutinized social entertainment segment, things like live streaming, dropped sharply. Why? Well, social entertainment got hit really hard by regulatory cleanups and anti-gambling rules. So they successfully replaced a shrinking, risky revenue stream with a much more stable, recurring subscription model. And honestly, that is a very real legitimate achievement. And that successful pivot, it left them incredibly well capitalized. They are sitting on 41 billion RMB in cash, term deposits, and short-term investments as of the first quarter of 2026. To put that into perspective, that's roughly 5.6 billion US dollars. Add in over 10 billion RMB in operating cash flow every single year, and their balance sheet is absolutely bulletproof. So from a pure survival and stability standpoint, TME is deeply, deeply entrenched. But remember, we aren't just looking for survival here. We're hunting for exceptional investment quality. Which brings us to Section 2, the moat, narrative versus reality. So the bullish narrative sounds pretty much unstoppable, right? You've got massive scale, incredible cash flow, and privileged traffic fed directly from the broader Tencent ecosystem. But when we start peeling back the layers, it reveals a surprisingly narrow moat. First off, they are highly dependent on record labels for content because they don't actually own the music. Second, they're still sensitive to sudden regulatory shifts. And then you add in fierce, intensifying competition, particularly from ByteDance-backed Soda Music, who is aggressively pushing into this exact space. Suddenly, those ecosystem-assisted advantages start to look a lot more vulnerable. It's not quite the impenetrable fortress the scale suggests. So how do we grade the leadership team navigating these waters? Well, it's a bit of a mixed picture. Their operational execution is undeniably strong. I mean, they fixed the revenue mix and they kept the cash flowing. But their strategic vision and stakeholder communication, those really only rate as fair. Like we said, their biggest advantages were largely inherited from Tencent, not invented from scratch. And as we're about to see, some of their recent choices regarding transparency are raising some serious eyebrows. Just check out this profit breakdown for 2025. TME reported massive operating profit growth, which sounds fantastic, but the headline margins actually overstate their true day-to-day earnings power. Look at this. A huge chunk of that profit didn't actually come from selling more music subscriptions. It came from a one-time gain related to Universal Music Group, plus some preferential tax benefits from the Chinese government. So yes, it's a good business, for sure, but the clean accounting profit isn't quite as heroic as a quick glance at the headlines would have you believe.
All right, let's move on to section 3, the transparency problem. And honestly, this is the most concerning part.
Let's look at the directional trends from the end of 2025. Monthly active users were actually down 5%. The overall audience is shrinking. Yet paying users were up over 5%, and the average revenue per paying user, what we call RPPU, jumped over 7%. So what does this tell us? It means TME is successfully squeezing more money out of a shrinking base. This is a classic late-stage optimization signal, folks. It's not pure organic expansion. They're pushing up prices and conversions to offset the free listeners they're losing. And while that works for a while, it definitely has its limits. And here is where it gets highly, highly problematic. Just as that competitive heat from Soda Music is really intensifying, management announces a massive rollback in what they report to the public. Starting in Q1 2026, they completely stopped reporting quarterly monthly active users. They stopped reporting quarterly paying users, and they stopped reporting quarterly revenue per user. They essentially just reached over and turned off the headlights. Without these metrics, it is nearly impossible for us to distinguish whether their future revenue growth is coming from true durable user loyalty or if it's just short-term pricing tricks and aggressive bundling. The investment memo summarizes this perfectly with this quote: "The lost transparency removes the cleanest way to test the investment case." And that is exactly right. You simply cannot underwrite a business as a high-quality compounder when management literally turns off the headlights exactly when competition is heating up. It's a hugely investor-unfriendly move that really downgrades the quality of the reporting. And compounding this whole issue is a phenomenon we call ecosystem creep. Basically, this is when a company shifts capital from their core dominant product into adjacent bets just to keep the growth story alive. Timmy recently shifted billions of capital into adjacent bets, like dropping $2.4 billion to acquire the audio platform Shmalaya and taking a major stake in K-pop's SM Entertainment. Now, diversifying into podcasts and merch? Sure. It makes sense on paper, but massive capital shifts like this often suggest that the core dominant product, in this case music streaming, is running out of runway to drive the kind of growth Wall Street demands. The core moat just might not be enough on its own anymore. Which brings us to section 4, the final verdict: cheap versus great. So weighing then massive, solid balance sheet against the shrinking users and the newly hidden metrics, we arrive at valuation. Morningstar points out a very tempting price-to-fair value ratio of 0.36x. So by almost any traditional metric you want to use, TME's stock is undeniably, statistically cheap at current levels. The market has heavily, heavily discounted it. But wait, here is the catch. At the exact same time Morningstar is calling the stock cheap, they also aggressively slashed their 5-year forecasts. They cut revenue projections by 13% and profits by 12%. Why? Because the threat from Soda Music is very real and it's eating into their future growth. So that cheap valuation is deceptive. It's cheap because the future just isn't as bright as it used to be. So the huge, absolute, crucial takeaway I want you to get from this entire explainer is this: cheapness does not equal greatness. A low stock price doesn't just magically transform a good, narrow-moat business into an exceptional, long-term compounder. You are buying a business that is financially safe, yes, but strategically very opaque right now. Therefore, my final verdict is clear. Put it on the watch list, not the portfolio. Look, until management restores transparency around their user base and actually proves they can retain paying subscribers organically through this intense competitive cycle, without hiding behind accounting changes or massive acquisitions, TME simply does not clear the high bar required for a long-term capital commitment today. I'm going to leave you with this one final provocative question to chew on. Can TME actually hold its monetized users through a full competitive cycle without hiding behind lost transparency? Until we can look at the data and answer that with a resounding yes, the smartest move is to observe this one from the sidelines. Thanks so much for joining me on this deep dive. Always remember to look past those surface numbers, and I'll catch you on the next explainer.